Chapter 21, Financial Statements. In this chapter, we get to discuss all of the information that a company would list to show their current position financially. Financial statements are used, once again, to allow companies to know where they are at any given moment in time for the purpose of being able to use that information to better make managerial financial decisions. So in this chapter, we have three major learning outcomes. The first learning outcome that we will look at will be the balance sheet. Second, income statements. And thirdly, financial statement ratios. So let's get started with the balance sheet. The balance sheet is a type of financial statement that indicates the worth of financial conditions of a business as of a certain date. We call this a snapshot. On this date, this is what our balance sheet looked like. These are the values that we had in our assets, our liabilities, and our owner's equity. So you would ask, what is an asset? Well, assets are properties or anything of monetary value that a company owns. Now, we are again in this chapter about companies, but individuals as well can create balance sheets to show their current financial condition. When we look at assets, we also look at the categories under those assets. We'll talk about that later, coming up. But the second part of a balance sheet are liabilities. Liabilities in general is anything, any money that a business owes another business. If we was to buy products on credit to defer payment to a later date, then we owe that money to someone else. That is a liability. If we borrow money from a bank or someone else, that money that we owe the bank or someone else to the company is a liability. So a liability is anything that you owe. And then finally, we talk about equity. Equity really is the net worth of the company. So let's get started and take a look at our assets. Assets, once again, are properties owned by the business. We break them down into sections. First being current assets. Under the current asset column, we have items such as cash, money in the bank, as well as cash on hand. We have accounts receivable. And accounts receivable is money that customers owe the business during the course of business. A customer may purchase something on credit, but they owe us that money, so we call that an account receivable. We set up an account with our customers, and when our customers purchase on credit, that account with that customer is an account receivable until they pay us whatever they owe us. Notes receivable is another current asset, and these are promissory notes owed to the business. If the company lent money to someone else, then these notes or loans are owed to the business and they are receivable. Therefore, we call them notes receivable. The next current asset is merchandise inventory, the value of merchandise on hand. Any product that we have that we're going to be selling, but it has not been sold yet, is in the inventory to be sold. We keep track of that. That's an asset to us, and we call that merchandise. inventory. Office supplies are the values of supplies such as your stationery, pens, paper, computer storage devices can fall under this office supply category, like hard disks, little pen drives, these type of things. Now, the next part of the asset group is a category that we call plant and equipment. Plant and equipment. But from an accounting standpoint, we call it plant, property, and equipment. Okay. Under this category, we have business equipment. Business equipment are equipment that the company uses in the course of business. And when we record any asset on the balance sheet, even though we have these different categories, what we are recording is the actual value that we have in these particular items. So business equipment will show the value of equipment, things such as tools, display cases, machinery, and so on. Things like this that the business owes, not owes, but owns. The next category under the plant, property, and equipment would be office furniture and equipment. Under this, we will list the value of the total of all items that we have for office furniture and other office type equipment. This category would include items such as your desk, your chairs, filing cabinets, computers, printers, calculators, other type of office equipment. All goes under this one category. Then we have an area under our not current, but liabilities, plant and equipment, called buildings. Buildings, of course, are all the buildings that the company owns. They could be on the current site, or if they own buildings on other sites. All buildings that the company owns are listed on the company's balance sheet. We show the value. And incidentally, if the company had multiple branches, you might identify each branch, and then list them out. So we can further break these categories down under the subheadings if we want. But for this purpose of what we're doing today in this chapter, we'll just use the broad category of these items. And then finally, this is the property part. It's called the land. Land is the actual physical land on which your buildings stand that the company owns. The value of this land is recorded on the company's plant and equipment section of the current assets or the asset group. The second area that we can look at are liabilities. We said liabilities are amounts that the business owes, not own, but owes. Current liabilities would be the one group under this section, and these are those liabilities that must be paid shortly. Under this category, things such as accounts payable. Accounts payable is any money that the company owes for merchandise or services that it received but not yet paid for. Notes payable is another area. These are promissory notes, small loans that the company has opened up with someone else but has not paid yet, but must pay them shortly. And then wages payable. If the company has employees, at any given time, if they have not been paid yet, the amount that the company must pay them is held in the balance sheet on a liability item called wages payable. And of course, at the date of the balance sheet, this would be the total of how much money that the company must pay for employees that has accumulated since the last time they have been paid. Liabilities has a second category, and these are your longer term liabilities. These are liabilities that you might make monthly payments on them, but the liability will span longer than 1 year. The main category would be your mortgage. Mortgages could be 10, 15, 30 years. that you have to pay on them. And these are considered long-term liabilities. Nonetheless, it is the debt that is owed on the buildings and the land that the business owns, mortgage payments, mortgage payable. Okay. The last section that we will find on our balance sheet would be the section for owner's equity. Now, what is owner's equity? Owner's equity is the difference between the company's assets and the liabilities. The difference between the company's assets and their liabilities. So, if the company is a private company, then we call it owner's equity. But if the company is a publicly held company, they have stock, they sell stock, common stockholders purchase ownership in the company. So instead of calling it owner's equity, we also would call it stockholders' equity. Okay. The difference between assets and liabilities is the equity in the company. It is your net worth, basically. Capital, proprietorship, or net worth. These are other terms that we would use for your owner's equity. So you would hear these types of terms in different situations, but it's all talking about the same thing. It is the net worth. After you take out all of your liabilities, and if you was to liquidate all of your assets, convert it all into cash, and then paid off all of your liabilities, the amount of money left is what is called your net worth. This is what the business is worth. That is your equity in the business. Okay, let's move forward into what is called the basic accounting equation, and it's important when we're talking about a balance sheet. The basic accounting equation states that your assets are equal to liabilities plus the owner's equity. Your balance sheet must balance in this way. When you itemize all of your assets, total them up, itemize your liabilities and your owner's equity and total them up, the two numbers should meet and equal. Okay? Let's take a quick look at a balance sheet. In this case, we see Sanders Woodworks balance sheet as of December 31, 2010. Now, take a quick look at this. This date on this balance sheet is very important because anyone looking at this balance sheet will know that the data on this balance sheet, the values that would be listed on the balance sheet, would be the values as of this date. If the balance sheet was created once again on January 1st, then it very well could be different in the values. Because as the company goes from day to day, transacting business, cash and liabilities and equipment, all kinds of things on this balance sheet can change. Therefore, the values of these items could change. So the snapshot would be this actual specific date given on this balance sheet. Okay. Take a quick look at the construction of this balance sheet. We are talking about accounting now in this chapter. Accounting follows what are called generally accepted accounting principles. In the industry, we call them GAAP, G-A-A-P, generally accepted accounting principles. Now, that standard tells us that when you are creating a balance sheet, there's an order in which that balance sheet should be created. You don't just randomly throw things up in there. You organize them, keep things in an organized, orderly fashion, starting with your assets. Under your assets, you then put your current assets. These are things that could easily be converted into cash very quickly. Current assets, list them out, total them, and then go into your plant and equipment. List those different things out, total them up, and then total that category with the total current assets, and then call that your total assets. Okay. Then you move on to itemizing your liabilities. Under that section, you first list your current liabilities, items that must be paid shortly, in the short term. List them out, itemize them, show the values, total them. Then move on to your longer term liabilities. Once you list out them and total them, you then total your current liabilities, add that to your total long-term liabilities, and that would give you your total liabilities. You total that up and you set it out. And then move on to your owner's equity section and then list out whoever the owners are. If it's stockholders, put stockholders' equity. If there's one owner, you put his name and his capital. That would be his account. J. Sanders equity, J. Sanders owner equity, J. Sanders net worth. But this is the same thing. Owner's equity section, you put that in there, total that up with the total liabilities, and those totals should equal your total assets. Okay, so that is a quick look at the balance sheet. Now, when you take this into consideration, we can move on into knowing that when we prepare a balance sheet, we prepare it exactly in the way we just saw it. And take a look now at a balance sheet. In this case, this is an example where we were given the values of a current business, Sanders Woodwork, at December 31, 2010. We were given all of the information about this company, and we were asked to prepare the balance sheet. Once we prepare the balance sheet, it would look in this way. Notice, once again, the name of the company is there. What type of report, what kind of financial statement is it? It's the balance sheet, so we list that, very clear. And then, when was it created? This was the date of the creation, and these are the values listed at that date. Notice under the assets, they went and put current assets first. There we list then all of our current assets in order, as we see. And usually, if you notice the order in which these are, cash goes before accounts receivable goes before merchandise inventory, so on and so forth. We're not going to drive this home too critically now, but if you were studying accounting, then you very well would know the order exactly. When you have multiple assets, what is listed in what order. It's very important because generally accepted accounting principles dictate this standard for us. But anyway, after you list all of your assets, your current assets, you draw a single line under them, then you give your total current asset amount, and under that number, you draw a single line. That's your subtotal. Then you move down and you list your plant and equipment. List that out, and at the end of that, you draw a single line. And then for your total, if there's no other plant and equipment there, then you draw a line under that for your total, a single line. And then if there's no other assets to be listed, you give your total assets, and after you total that amount, you draw double lines under that amount. That is the standard that we use in the balance sheet creation. Okay? Then you go down to your liabilities, you set up your liabilities, you itemize your current liabilities, you put them in order. When you total them, single line. At the end of them, you draw a single line for your subtotal for your total current liabilities. Then the long-term liabilities. Total them up, add a single line, then under that, excuse me, excuse me. And then when you get to your final owner's equity section, you want to make sure that you total that up, draw a single line, and then for your total liabilities and owner's equity, total that up in a double line. once again, you will know that your total assets should equal your total liabilities and owner's equity. So there is how we create a balance sheet. At this point, it's probably a good idea for you to take a practice with these stop and check exercises. Take a look at one or more of these. Take a moment, fill it out, check your answers in the back of the book to make sure you're on the right track before moving forward. And so in the next video, we will discuss how to prepare a vertical analysis of a balance sheet. We'll see you then.